Hello traders, Gary Wagner here just after 12 o'clock in Honolulu, 6 o'clock in New York. It is Thursday, 14th day of September, 2017, and this is the Daily Report for gold and silver. We do have modestly or moderately higher pricing in the precious metals across the board. We did send out a special trade alert this morning to initiate long positions in gold. Of course, we will go over that in detail as we pull up our technical studies. But gold did close higher up on the day, up about $4.80 at $13.34. The low, which was interesting, came in at around $13.19. So we've had quite a range today. Silver up about 7 cents, but still below 18, $17.86. And the dollar did decline about 0.4% above 92 at 92.11. Now, slightly, moderately lower pricing in U.S. equities, with the Dow still above 22, 2203, the NASDAQ 6429, and the S&P 2495. This morning we issued a trade alert recommending that all of our subscribers initiate long positions in gold. Gold was trading at $1331.80, up about $4 or so on the day. We now have gold trading at $1333.60. And so what I wanted to do on today's show is to detail the technical events that led up to today's trigger and initiation of long positions in gold. We are looking at a very short-term chart, 240 minutes per bar with Elliott wave as well as Fibonacci retracement. I kind of like to think about them as Russian dolls or a fractal nature behind the actual Elliott wave count, because when you look at the count, your up count is basically 1, 2, 3, 4, and 5, in which you have basically 3 impulse waves, which are 1, 3, and 5, and then you have 2 corrective waves, 2 and 4. However, within those, you can subdivide or break those particular counts down. So on a wave 1 up, you could then break that into a 1, 2, 3, 4, and 5. And then on the way down, you could also look at something like an A, a B, and then our final C. So when we're looking at a daily chart, in order to really get an idea of the conclusion of a small corrective wave, such as wave 4, which is where we're currently at, and that would be this move right in here, we need to break down the time cycles of the studies that we're looking at to be able to actually detail that kind of a move. Now, based upon our current scenario, we've talked about this before, we're looking at the move starting from $1,200 going up to $1,280 as a wave 1. Our corrective wave 2 comes in like this, and as you can see, that can be subdivided into an A, B, and C with a shorter term chart. We then have this long extended wave 3, which you could then divide into a series of numbers. But here's the important part as it reflects to today's call. When we look at the recent price decline from 1360 to the low that was achieved today at 1319, we can then break that up into an A, a B, and a C wave, concluding wave 4, which would mean that we are now into a 5th wave. That would be this wave right in here. If that's the case, and if we are correct, we have basically hit the bottom. The bottom came in as an exaggerated low this morning at 1319. The market's at 1333 plus, so we have definitely propelled ourselves from that price point. But as we have spoken about over the last couple of days, the fact that we have waves 1 through 3 and now 4 in place, the forward forecasting model of looking as to where this rally could go to is a pretty clear cut and a fairly easy calculation, because what we're looking at for in this model is basically a 1-to-1 relationship between wave 1. You've got this first wave here. You had a 23% retracement. You had wave 3, which was actually a 1.618% extension of 1, which is textbook. And now we have had this decline that came in at a 38% retracement, and it's a retracement of this most recent rally, meaning starting where the correction concluded and the rally then gets underway up until the top at 1363. Now, based upon that, we now have the beginning of our fifth wave in reference. And as we spoke about the other day, we would now look for a one-to-one relationship between this wave 1 and this wave 5. And so our forecast model takes us to $1,400 per ounce. And traders, lastly, we wanted to also bring in that third element that I spoke about yesterday, which is candlesticks, meaning we look for the market to fall to a certain area. We'll base that upon a Fibonacci retracement theory. We will also fold into the mix Elliott wave count so that we have some sort of timing that tells us we might have seen a conclusion to the current wave that we are in. And then lastly, we use candlesticks to actually trigger the call. I have converted our bar chart into a candlestick chart, and you can clearly see as this market bottoms, we look at these three candles, this one here, and this one here. We get our three-river morning star, we get our confirmation, and of course, at that point, we entered the market from the long side. Traders, my recommendation is to maintain the long position you initiated today, and our initial stops are below 1318 because we've had a low today of 1319, and we're just placing it below today's low. Traders, behind the scenes, there is a lot that goes into the triggering of a buy signal here at the Gold Forecast. Our longtime subscribers know that we use a triple filtering system. We combine Fibonacci retracement theory, Elliott wave, with candlesticks, and we wait for them to line up kind of like a puzzle, and that will trigger the buy signal. That's exactly what happened today. We spoke about the different variables in today's show, and hopefully this will be a very successful trade for us. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.